Well, good
Cool.
morning, Suranga. How are you?
Really well. How are you?
I'm all right on this rather wet and grey Friday in November.
It's a
Which,
Friday. Think of the positive.
yeah,
Yeah.
one could say that. So,
Yeah.
I think first of all, what we always try and do is just scene set. Naturally, you work for Balderton. I imagine a large number of the people who are our listeners and watchers know Balderton, but there may be a few newer sort of incumbents in the industry who aren't as familiar. So a good first step is always Balderton, maybe Saranga, pre-Balderton. What's the sort of the stepping stones of VC and where you got to now?
Yeah. No, definitely. Happy to share that. So I'm a partner at Balderton Capital. We are a 21-year-old venture capital firm. We're based in London, but we actually invest across Europe. And historically, we're very focused on early stage investing. So really sort of seed and Series A stage investing. And yeah, we've done that for, like I say, 2 decades. And as part of that, have been fortunate to be part of the early founding story of a variety of large European technology companies, everything from software companies like Contentful, which is a $3 billion German software company, to consumer companies like Depop, which is a millennial clothing retail business that was sold to Etsy this year, to fintech companies like Revolut, which is a neobank that's based out of London but operates in about 30 markets now. That's the sort of thing we've always invested in. That's the sort of thing we've always focused on. In the last couple of years, we've extended our strategy to also do some slightly later stage investing. So we added 2 new partners to the firm last year, and those 2 partners have raised a new fund and will raise a fund going forward in parallel to the early stage fund that will invest in sort of Series C, D, E companies. So those are companies that have really figured out what their strategy is, figured out what their product and business is, but now need capital to sort of fuel the growth to the next stage.
Is that the 600 million fund, or is that
No,
also that's a different fund?
it's separate. So in total we have about $1.2 billion in sort of current management. So about half of that is in growth. It was a $680 million fund that was raised earlier in the year. And then the 600 you're talking about is the early stage fund, which was just closed. Actually, we just announced it a couple of weeks ago. And that will be on the early stage. And so we take that money and we basically deploy it over a 2 to 3 year period across Europe in technology driven high growth businesses. It's classic venture capital, so it's high risk, high potential stuff. So many of our companies don't make it, despite the best efforts of us and of course the founders and the teams. But of course, every now and again, you get some that really, really do make it and sort of change the world. And those are the ones that we're looking for. And then me, just quickly, before this, I started off as a computer scientist. So I have a software degree and background. I was a software engineer for many years. And that journey and that career took me to the Bay Area. And I lived in San Francisco for a few years. While I was out there, I really wanted to start my own company. And so I dropped out of my job and became a CEO and founder of a business called Blinkx, which I ran with my co-founder, Matt, for about almost 10 years. I think I was CEO for 9 years. And in that time, we took it from the 2 of us and a couple of ideas to being a multinational, multi-$100 million business. And we even took it public. So we took it public in London, and spent a bit of time as a public CEO before retiring to the board, becoming chair and passing it on to my number 2. And then after that, I was trying to figure out what to do next and decided I was going to move back to Europe and be a VC. And that's when I joined the firm back in 2014.
Oh, thank you. And Blinkx. Interestingly, I did do a lot of work with Blinkx. I think obviously your predecessors on the management side when I was at Bloomberg, which it's quite interesting. I had several San Francisco trips where they presented, which were it's an interesting business. So if you my ears picked up on a few of the things you mentioned there, Suranga. First one is we constantly have this debate with a lot of the different funds that join the show on the classifications of seed in the UK now,
Yeah.
and I suppose Series A, and obviously, what would Balderton's classification be on those two segments?
Yeah. I mean, we've discussed this a lot. I think I'm less fixated. I think we as a firm are generally less fixated on a particular valuation anchor or even size of investment. And it's more about the development stage of the company. So I would describe pre-seed as being, one or more people who have a really interesting idea, who've got together and committed to building something in that area, built on that idea. I would say seed is when that team have now built the first version of that thing and they have got it out there, they're sort of trying it out on the market, whatever that market is. Series A is once that product has been launched and now has demonstrable, repeatable data that it's really working. So the customers they've tried it on are using it, they like it, they want to buy more of it, there are more of them out there, and so on. And then Series B is once you have not just got those customers really working on it, but you've actually got a real engine of growth, if you will, that if you pour more of this in this end, more will come out of that end. And then CDE, I think it's just more of the same. We've got this thing that works, we know the engine works, now it's a matter of taking it into a new market or expanding the product range or whatever. But to me, those are the distinctions. So when we do seed investments, it's usually a small number of people with a really powerful idea. They built the first version that you can play with. I think that's important for us because it sort of demonstrates commitment to the cause that you've actually built this thing. But you may not have much traction yet. You may not have much data, but if it's an area that we feel we really understand very well, then we may believe that because we understand it well, we can take a risk on whether the market will get it. And then Series A is when you sort of reduce that risk by saying, okay, interesting idea, but we don't feel confident enough that we know the market you're going after. So, come back in a year when you can show us that people really like this thing.
And you mentioned about the sort of valuation, sort of, it's always something that I suppose, big VCs like yourselves, I suppose you kind of obviously have 21 years in the game of doing this. So naturally the valuation, I suppose, the decision sits between you and each individual founder, I would assume. But would there be a kind of, I suppose, maybe a percentage that if you were to do, is it 10%, 15, 20%?
Yeah.
Is there any kind of metric there?
No, absolutely. I mean, I think so. It depends a lot on the strategy of the firm, and different firms have different strategies, even sometimes have different strategies at different stages. In our case, we are, whether we do a seed investment or a Series A investment or even a Series B investment, we are sort of low frequency, high conviction investors. So we don't do that many investments. When we invest, we really believe in what the company's doing. So what that means is that we will have the time to really spend on the company. So we're not just we're not just a minority owner, or we're not just a board member. We have someone who's there every week. In fact, today's Friday. I spend my Fridays usually just doing back-to-back calls with each of my CEOs, just catching up on everything that's happened. And I do that with most of them every week. So very involved in what's going on. But commensurate to that involvement from us is the need for ownership, right? Because if we're going to spend that much of our time on a small number of companies, we need to make sure we own enough of those companies such that when one of them becomes a huge success, we can sort of pay for the returns that we need. So we generally aim for, if we can, a 20% ownership regardless of stage. We can't always get that, so we're usually pretty happy with 15%. We rarely go much below that, because once you get below that, you're getting to the point where even if it's really interesting, I'm not sure I can afford to spend the amount of time that I would normally spend on you. Now, there are other firms that do different things. There are other firms where, particularly at seed investing, they take more of an indexing approach, and it's more like, let's just own 5% of a bunch of really interesting stuff. And that can work too. I mean, there are some people who've got brilliant returns doing that. It's just not the way that we choose to run the business.
Just kind of interested in when you were talking about your experience of your own exit, and you chose to list in London, you said, right? Do your IPO on the LSE. I was kind of interested, when you guys were coming to that decision, was there a bit of a debate about where to list? Was there an option to list in the US? Can you talk a bit about that?
Yeah, there wasn't a huge debate. In our case, because most of our founding investors were UK based, because the company had a sort of UK history originally. It was a sort of fairly natural place to list. We did discuss it a little bit, but also because we listed relatively early, the London market was actually more flexible and more a better home, certainly in those early days. Once, I think after we listed, interestingly, it was more of a discussion, because we definitely had moments in our journey when we felt as though the London market really didn't fully understand what we did. And sometimes that worked in our favor, right? If things are all going well, then people not understanding too much can be good. People just keep piling on. But obviously, it also goes really badly wrong when things aren't going well, because it's impossible to have an intelligent conversation as to what's working and what's not working. So I think that was always a bit of a source of frustration for us. And in those moments, either good or bad, really, it wasn't just the bad ones. The good ones were also a bit frustrating because you feel like you weren't really getting your message across. And at those times, we definitely had a debate internally about whether we should do a dual listing in the US or move to the US or whatever. I mean, I think the reality is we had so much to focus on operationally, we never really got around to doing that, so we didn't do it. And interestingly, now Blinkx exists, it merged with another business and they ended up flipping to a US listing. So now they're listed in the US markets. So I'm not surprised about. I think that was always in the future of the company. But it didn't happen in my time. But yeah, so the London market is, and bear in mind that, I went public over 10 years ago, so it's changed a lot in that time. But certainly when we were public, it was hard. I mean, there weren't that many other technology companies. There were very, very few specialist technology analysts or investors. And so, I mean, they were smart people and they were, interested in learning, but there was a limit to how much they could learn because they didn't have, all day, every day to think about this stuff. So translating what we were doing into their language was a big part of what we had to do constantly. And I think when we did, as the company grew and the market cap grew, even though we were listed here, we had US investors. And that ended with me spending some time in the US talking to US investors and US analysts. And it was interesting to see the difference, right? I mean, there you had really specialist funds, specialist investors, specialist analysts. Unsurprisingly, they knew their tech, better for better or for worse as a company, right? They could ask much harder questions. But equally, they could stick by you when things didn't look good on the surface, but they understood underneath it what you were trying to do strategically. So I think that the UK has got a lot better since then. Like I say, over a decade ago that I went through this experience, but we've still got a way to go. I think it's undoubtable that the US ecosystem in the public markets is still a little ahead of where Europe is.
So do you reckon that founders of some recent IPO tech companies, Wise, Darktrace, Deliveroo, probably still feeling some of the frustrations that you felt a decade ago?
Yeah, I think so. But they're also, it's also, you have to separate out where the companies are struggling genuinely as well, right? And I think that some of the companies that have had a difficult first year or two have had a difficult first year or two for good reason, and they probably have the same challenges in the US. But others, I think, absolutely, part of the challenge is communicating with a generalist investor base. A different way of looking at this is like comparing the way I work as an investor with the way I remember some of my public market investors working when I was a CEO. They were very smart people, right? So I remember going into the various shareholder kind of investment meetings on a roadshow and being, apart from a few, unfortunate exceptions, always being impressed with the brains on the other side of the table. They were smart people. And I don't mean just that they had great credentials and academic records. When I talked to them, they clearly knew their stuff, right? So I don't think there's any kind of lack of quality or education problem here at all. However, if I then think about how much we communicated, we would basically have an analyst meeting, which would take an hour or two on the day we reported our results. We would then have at most an hour with each of our shareholders. And we would do that at best once a quarter, sometimes twice a year. So, they're trying to make, decisions involving tens or hundreds of millions of dollars on the basis of yeah, like I say, between 2 and 4 hours with me, plus maybe their analyst spending an extra hour or so with me, or an analyst they work with. It's not a lot of time, right? And I mean, I just told you that when we make a new investment in a seed or Series A company, I put out an hour every week. That's kind of the default that we must spend together, and then often we put more time in than that. Now, it is different. My job is a lot more hands-on, and I particularly in the early days, I do help with hiring, I help with strategy, I do a lot of feedback on product and all those things. I wouldn't expect public market investors to be doing all of that. But the sheer exposure they had to me was dramatically less than the exposure I have to the companies that I invest in. And I question how much they can possibly really understand given that level of exposure, even though they are smart, even though they want to do the right thing. So yeah.
So I'd say, so in that case, Suranga, it's in effect, you're doing a lot more research and due diligence and general work with a business when they're private for a much, much longer period of time, and it probably investing, I suppose, less money on average. And flip it the other way, the public markets and where it's kind of going wrong is exactly what you just said. So they're doing less work with more money, or investing more money. So kind of really interesting analogy there. And
now on the flip side, I think that the big advantage they have, just to be fair, is the transparency and volume of data is significantly larger at their stage, right? So first of all, the business is bigger, so there are just more numbers and they're more meaningful. And secondly, you have the regulatory requirements which protect us all and make sure that the company has to provide the data in a particular form. They can't hide behind clever accounting, or if they do, it'll get exposed. Big part of my time is spent with early companies like, okay, I can, great, you figured out a way of arranging your numbers so it's up and to the right. That's not going to help me, help you build your business. Like, we need to figure out whether it really is going up and to the right. And so they don't have to do that, so they do have some edges like that. But yeah, it must be hard for them. I don't begrudge them that task.
So just you mentioned, I suppose I'm taking a bit of a step back. So you mentioned some of these great names like Maria Raga at Depop, Nikolai at Revolut.
Yeah.
With Balderton and where you operate, you mentioned the partners for the later stage of investments. Is it specifically when you find a Revolut or a Depop or a Vivino, do you go all the way right through to even holding stakes in those businesses when they're public companies? Is that the idea?
Yeah, we do. And so with the early stage fund, we will, obviously we invest to get into the company, and then we will do some investing from that point on in some of the future rounds, mainly to maintain our stake more than anything else and be supportive. But our firepower dies out at a certain point. The fund is just too small to keep investing. The reason we raised a growth fund is partly in order for us to allow us to play in those later stages as well. But even if we didn't, as we didn't in the ones you've mentioned, because we didn't have a growth fund when we did all of those, we are, major shareholders and will remain major shareholders until something happens to the company, goes public, gets acquired, or whatever else.
I read kind of an interesting piece. I don't remember where it was from, but they were talking about how in the US, a lot of the great VC firms out there, a lot of their mantra to the startups is the IPO is not the finish line, it's actually the start line, right? And that's when another big journey begins for you. But because VC funds, being like closed-end funds, 80% of their capital has to be in private companies. And they were actually highlighting how in the UK, because there's some AIM-listed VC funds, they can sort of get around that. Do you think that trend will sort of, continue, and more later stage funds will go AIM listed so that they can hold on to their public IPO scale ups and that sort of thing?
It's an interesting question. I think the core funds that we invest out of now do need to exit typically around or after IPO, fairly soon after IPO, just because of the duration of hold period by that point, right? So when we invest in yeah, I mean, we were the first institutional investor in the Huck Group, right? So we led that round in 2010, I think, and the company went public in 2020, so 10 years later. So at that point, that fund was already 11 years old. That investment was 10 years old, and it doesn't make sense for the investors in that fund that we hold it for another 10 years, even though it's probably a great company for the next 10 years. And so whether we return stock or sell our stake and return cash, I think that fund does need to sort of release its holding around then. But there is an interesting argument about whether you can structure some way which would allow some of the investors who were interested in holding the stock as a public company to do so. And that observation has been really big in the US, I think, around a lot of the really interesting companies have seen much larger appreciation of their value post IPO.
Spotify, great
Yeah.
example.
Yeah.
1000% increase.
Exactly. So if you were a VC who'd sold on the IPO or 6 months later after the lockup or whatever, you'd have lost a lot of that. So anyway, I think we will see more firms figure out ways of maintaining that ownership going forward. One way is doing it through something like an AIM listing, you're right, but there are lots of other mechanical ways of doing it, and I think we'll see a bunch of them. The really interesting one that's changed recently is Sequoia, right, which is the preeminent venture firm in the world, and Sequoia have just restructured all of their funds, and they now have this thing called, I think it's the Sequoia General Fund, which is their sort of core fund, and then they have a whole bunch of other strategy funds that sit around it. The strategy funds do what their historical, early, late, US, European, Indian, Chinese, etc. funds used to do. But when those companies go public or they get to a level of tenure and sort of appreciation, they can then get reshuffled into this core fund. And the core fund can basically hold it for longer and be more of a sort of open-ended fund. And so, it can be done in other ways. It doesn't need to be a public listing, doesn't need to be an AIM listing. But I think it's solving the same problem, just in a different way, right? And in a way, the mechanics are, they're the detail, right? The real thing is, technology, again, I think because of its proliferation, it continues to accrue value. And if that's the case, if you sell out after the first 7-8 years, when a company goes public, it's limiting. Now, also remember that many of our companies end up being acquired, and then you don't always have any kind of option to hold beyond that. So, Depop is a great example. They were acquired by Etsy, and it was a cash deal. So, I guess we could have turned around and bought a bunch of Etsy stock at that point, but that it would have been pretty artificial.
So you interestingly mentioned Sequoia. We've talked many a time on this show about the theme of the US VCs coming more to the UK and Europe and going down the pipe and being involved in seed rounds. I've always wondered, with some of the great, I suppose, British VCs, which would be obviously your Good Sales and Draper, and aspirations for you to go over to the US and play in their back garden. Is that on the sort of menu or not really?
I think it absolutely is. I think we have no plans to do that as a firm ourselves today, but you could do it. You absolutely could do it. And the best example of that is Index Ventures, who were started in Switzerland and were really pan-European, just like us, for the first 10 years of their history. And then, about 8-9 years ago, decided to go into the US and went into the US and have done incredibly well.
Yeah, successful, very successful.
Yeah, very successful, very successful. They're a top tier firm in the US. So, I think have really surprised and impressed a lot of the local US players by sort of turning up and actually doing a great job. So, it can be done.
Sorry, Suranga, did they hire people on the ground in the US to do that?
In their case, it's a firm that started off as a family firm originally, and one of the brothers, Danny Reimer, had he'd always been educated, I think, in the US and had been to college there and lived in the Bay Area as a banker for a number of years. So he was pretty American anyway, and very well connected into that world. And then yes, they hired another American partner when he first started, and then since then it's been a mix of people. But yeah, they did it properly, is the way I describe it. I mean, it's a bit like the way that we looked at our growth fund. When there was an option for us to raise a growth fund and just have the same team invest out of it. And we sort of said, no, this is a different job. It's a different practice. Let's build a team that knows how to do that. And our two new partners, David and Rana, David came from SoftBank and Rana came from Goldman Sachs. They both did late stage investing at those places. So they know what they're doing. That's their core focus. And in the same way, Index said, if we're going to go out there, let's build a proper team and be based in San Francisco and do it properly, which they did. And they've been very successful. So I think it can be done. I think we will see it happen. For the last 4 or 5 years, European venture has outperformed US venture and actually Asian venture. So it's
substantially.
Yeah, 20-30%. So based on sort of return rate. So the best, unsurprisingly, the best data for this is data that British Patient Capital and EIF have on this, because they have really large European portfolios. And the US portfolios are pretty discoverable because all of the large US sort of state funds publish all the data because they have to. So you can compare the data pretty clearly. It's pretty transparent. And actually, European returns have been very impressive. I think that will give a level of momentum and resource, frankly, to European firms. And some of those will use that to go out there. So I think we'll see more of those.
So you talked about languages, and I suppose in a slightly corny way, one of the newest technology languages we've come across in the last month or so is the metaverse. I'm just kind of curious, how do you size up an opportunity like that with the, because clearly certain people in Palo Alto or the Valley are hoping that this is going to become a reality that we're going to part live in or fully live in. How do you look at that as an opportunity to perhaps invest in players or work out where do we need to be in this moving forward? The
tag-along question of this is, is it too early to even be talking about the metaverse as well? I'm still a little confused about the actual timeline to this, right? And if we're right at this is the start line, or, it won't be mainstream really until, 8 years from now or something.
But that plays into a VC's investment lifetime, doesn't it? Really?
So I think we're already there. Next. So my challenge to you is, walk out of the door after this call. I think you're both in London. Go get on a tube train or a bus, and look around while you're on between 2 stops, and tell me what you see. And I'll tell you what you're going to see. You're going to see 80% of people staring at their phone for the entire journey, and those people are in the metaverse in my mind. They're just doing it in a very low fidelity, sort of slightly crappy way, but they're in the metaverse because
they're in the AOL metaverse.
Exactly. Well, slightly better than the AOL metaverse, to be fair, but they're somewhere in between the two. But that's the reality. I mean, we live a huge chunk of our lives in the technology network of one sort or another, and we absolutely do it with work, right? The 3 of us are doing it right now on this Zoom call. But we also do it through increasing amounts of our sort of non-work life, and that to me is the really interesting bit. And we've seen this across the board in our portfolio as people spend more time in all of the products that our consumer companies are building, especially over the last 2 years with COVID and the lockdown and everything else. And so I think actually the reality is, if you were to sort of try to abstract yourself and think about what is your life today and how is your life lived, it will be difficult for many of us to argue against the idea that we live our lives split across the physical world and the virtual world. And, we use both when each is appropriate for something that we want to experience or want to have happen. There are times when you do want to physically go somewhere and do something with someone. And when that's the case, you do that. And there are other cases where actually the virtual option is 1,000 times better. And that's what you do then. And so to me, the metaverse is just taking that reality, because I think it's really reality, to its natural conclusion, which is that, first of all, the edges of those two things blur. So they become so seamless that you don't have to think of this mode of, now I'm in real world mode, I'll do this. Now I'm in virtual mode world, I will do that. And instead, the two start to become, a bit more flexible. So, I think of things like meetings where today we're doing, this completely virtually. A few years ago, we might have done it completely together in a single studio. And, I think, we're beginning to do it in a hybrid way. There's a chance that, Chris and I could have been in the same room today and Anthony was in a different room, and Zoom can sort of do it, but not do it that well. With the right metaverse technology, with the right AR, for example, or VR, we would be able to do it such that the two of us would be in person together, and we would have a slightly better experience for it because we'd be in person together. If nothing else, before and after this recording, we'd be able to touch each other's hands properly and have a chat about something else, and there'd be a connection there that we don't have on the video. But Anthony will be almost as good in his virtual presence in that conversation when we did the recording. And so I think that's all that's happening. I don't think it's actually that big an idea. And I think we're actually already here. It's about saying, by building these really incredible, mobile supercomputers, we've created a world where a whole bunch of stuff happens virtually, and we do it without really realizing because it's just really good and much better than the physical option. And so now let's think about, what if you really made that really work and made it really seamless? What would that look like? And what are the technologies required to do it? What are the applications that will exploit that change? And that, to me, is what metaverse is. So as an investor, what I'm most interested in, as always, is the picks and shovels, because I think getting to that point of seamlessness requires a bunch of interesting enabling technologies. And I think a bunch of those are going to get built in Europe.
Does quantum play into this at some point?
Maybe, I don't know. I think it's probably orthogonal. I mean, quantum is important in the sense that it changes the framework of computation and what we can do with computation. And so, for example, you could argue that highly virtual world requires such scale of processing that quantum is the only thing that will provide it. But I think we can get to a pretty good metaverse without it, actually.
Fascinating.
So to get from where we are now to the metaverse, in your mind, from your perspective, what are the questions people need to be asking? What are the problems that still need solving? What's sort of your take on how to get from A to B on that?
Yeah, I think it's a bit of an unfair question. I mean, I think it's a bit like if we were sitting in if we were sitting in 1995 and you said, okay, this internet thing, or information superhighway sounds good. What do we need to do to get to the internet? And I would sort of say, well, the internet's already here. It's just going to get better, and it's going to be more developed, and we're going to use it more. And that would have been the truth. And I think that's the case with the metaverse. So it is already sort of here. But I think some of the big things that will happen will be on the interface side. I think there needs to be the right device that allows us to more seamlessly switch between real and virtual, and maybe that's AR glasses, maybe it's something else. I don't know. I'm not the founder anymore, but there needs to be something which allows us to do that. Right now, the device is the phone, right? And it's actually pretty good. I mean, the phone is always there in your pocket, and it allows you to dip straight in and out whenever you want to. But it's still quite a physical thing. It still requires you to sort of context switch. And I think that there'll be a device that will make that more seamless. I think that's going to be the key, because once we have that device, then we will have a much smoother ability to kind of go in and out of the metaverse. And that's what will then allow people to build metaverse applications. Because right now, you have to build an application that's so good that it beats the barrier of you remembering to use it, putting your hand in your pocket, taking your phone out, unlocking it, finding the right app, clicking on it, logging in. I mean, you've just already got bored, right? And actually, if that just happened because you thought it in your brain and your glasses immediately flicked, that would change the nature of the apps you use. So for me, the first step is a better UI.
Great, fascinating. Well, Suranga, I think we're running out of time. So it's been a fascinating chat. I think we've covered a lot of areas. Is there anything else that we want to talk about or have the time to talk about? Because I think we've got about a minute. But if not, I will say thank you very much. It's been a pleasure to connect, and hopefully next time it will be in the face-to-face or in the metaverse. You never know.
Either one.
And Anthony, any last comments from you?
No, just a massive thank you for your time. It's been a very stimulating conversation.
Yeah, thank you, guys. Really good.